You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rules-based investing, and of course where we also take some of your questions. But today we're going to deviate a little bit from our usual format because we are delighted to be joined by a very special guest, namely Peter Borish, a true legend in our industry. And I'm sure a lot of you are already familiar with Peter. So let me start out by saying welcome to you, Peter. Welcome to the show.
With pleasure. Thank you.
It's great to have you here. But of course, as usual, I should also say good afternoon to you, Jerry, and good evening to you, Moritz.
Hi, Niels. Hi.
Yes.
Jerry.
Hello.
Now, of course, we very much look forward to diving into your world, Peter, and find out what you've learned over the last few decades from being in the trenches. But before we do that, we normally do a quick review of the past week from the lens of a trend follower. So perhaps while you have an extra cup of coffee, we'll quickly go through some of the highlights from the last week or so. We're going to do a quick review this week, just so we have as much time with Peter as possible. Now, from my point of view and things that caught my eye, I mean, obviously it was a week where I guess there was a little bit in terms of at least the perception of risk being reduced in relationship to some of the political issues we saw around the world this week, China and the US, the trade war, of course, the protests in Hong Kong, people thought was cooling off a little bit. We'll see about that. And all of this led to a bit of a backup in yields, a weakening of the dollar and gold. So from a trend following perspective, a sell-off in some of the safe assets that have been doing well for us. And then, of course, the week finished off with a jobs report in the US, a bit on the weak side as far as I'm aware. And that kind of reminded market participants that maybe these trends are not completely over. Anyway, a week of corrections, I would say. Moritz, take us into your world of trend following. How was the week?
Well, you've just made a good summary. It's been just like you said. I think I had 2 up days, but overall the week was fairly negative, down more than 3% as a result of, we're pretty long the bonds, we're long gold, we're long silver, all of that moved down. Bitcoin around, 10,000 sitting there, not really moving at the moment. Also, I see that the emissions contracts, European emissions, which, I'm still long, struggling a bit given the background of Brexit. But, what can you do? I mean, it's been a good year so far. Every once in a while, those setbacks come along, and we just take them. But I didn't get kicked out of any of the long positions, so portfolio is still pretty stable.
Sure. I mean, from our point of view, it certainly also was a week of giving back some of the recent performance, roughly in the same region as you, Moritz. Fixed income and currencies were really the two difficult ones. Some offset in terms of offsetting some of those losses came from stocks. Softs and grains actually were okay. Metals for us, pretty flat for the week. If you look around the world and you see how politics are being done and conducted at the moment, not least here in Europe, it's kind of hard to see that some of these issues will be resolved anytime soon. So I'm sure we'll have to continue to expect volatility in the markets, but also in our performance as we always do. What about you, Jerry? How was the week on your side?
Well, just remember massive sell-offs in gold and silver, and so not surprising to be expected to have big moves like that. You're going to have some pullbacks, and it can be similarly volatile and crazy, or maybe those trends are over. Who knows? But those were the ones that stood out. I'm glad Peter's here because he can explain some of this stuff to all of us guys who just follow trends, because I think at one point we were worried about the stock market and their earnings and the recession and the inverted yield curve. But now that we had a weakening of the economy, I guess, or the employment, that helped stocks because maybe we'll get those, however many interest rates are built in. So as much as I like to understand or follow that or keep track of it, I don't try to ignore it while I'm placing my trades.
Yeah, no, I'm sure Peter will help us figure all of this out. But before we jump into our conversation with Peter, it is in fact the 1-year anniversary for this little podcast series. And one of our listeners, Jim, very kindly took us up on this new voicemail feature. So let me just play what Jim left in terms of voicemail.
Good morning, gentlemen. Happy 1-year podcast anniversary from Fort Myers, Florida. This is Jim. I enjoy the podcast every week. Several of them I've listened to several times and always glean some great information from them. Enjoy seeing you guys in October and getting together and learning some trend following techniques and tricks. Thanks, guys, and happy anniversary.
Jim, thanks so much for your kind words and anniversary wishes. We all very much look forward to seeing you as well at our New York live event in only a few weeks. And of course, if you want to leave us a voicemail, you can. We will try and share it on air as well. Just go to toptradersunplugged.com/voicemail. Okay, let's turn our attention to our special guest on this 1-year anniversary edition of the Systematic Investor Series. I think, Peter, you are really the perfect guest to have on the show for this, because I think systematic investing really has been, a big part of your career. So maybe to frame our conversation today, why don't you remind everyone of how you kind of originally got involved in this industry?
Well, thanks. It's a pleasure. As I said before, and it's a 1-year anniversary, and that's an honor as well. I was very lucky. I was working at the New York Fed in the early 80s. And if you think about it, my career has arced the development of futures markets. I started work in 1982, and S&P futures started in 1982. I was recruited out of the Fed by this young guy coming off the floor of the Cotton Exchange by the name of Paul Tudor Jones in 1985. And lo and behold, crude oil futures started trading in 1985. So we were fortunate in the sense of applying discipline, methodology, and certainly risk management to a lot of new markets that were coming online. In the late 80s, it was Japan, and by the early 90s, it was a global market with Europe, which just meant that one had to learn not to sleep because it's a 24-hour world and they're all linked. The irony is that Paul is an unbelievably great discretionary trader. And the difference between discretionary trading and sort of systematic trading is that in a discretionary trader, you can sort of have your size variable relative to the opportunity. So if you think it's a very small risk, you could take a bigger position. So assume you're risking certain number of basis points per trade. In a systematic trading, you don't know because it's a sort of equal probability of distribution of your signals. So you have sort of similar unit sizes across markets. And what Paul gave me the assignment on early on was, you know what? When guys like Jerry are really doing well, I'm not doing so well. And he said, why is that? And so after I spent a bunch of time trying to convince myself that Jerry was just lucky and not good, I realized that wasn't the case and that he was good. I'm obviously being facetious there. And I was head of research at Tudor, and then we set up a subsidiary called Tudor Systems Corporation. And my job was to try to develop models that would keep you in a market when it's moving. And that is a huge difference. A systematic person and Jerry just alluded to this, it forces you to stay in a market. Systematic traders are the only ones that were dumb enough to stay long JGBs when they were going from 1.5 to 1, from 1 to 50 basis points, down to 25, down to 0, because everybody says, oh, it's totally irrational. And now today we're seeing the bunds at minus 70, the same thing. So one, I always say you have to trade your own personality. So when you develop a model or a system, the characteristics have to reflect the author of that system in terms of what kind of volatility can they handle, what type of drawdown can they handle. And the notion of being a systematic trader or a discretionary trader is also a function of your approach to markets. It worked for us really well at Tudor because we had that complementary style. It was almost an internal diversification of approaches. And then I left and I had my own CTA, which was 100% model based.
Moritz, do you want to dig in with a few of your thoughts?
Thanks, Peter. Great to have you on the show. Maybe just, to go back, you've mentioned you started working at the Fed and then moved on to Tudor. I mean, what initially sparked your interest in trading? Were you always interested in the markets, or was there kind of like one moment at the Fed or when you first met Paul, when that happened?
Really good question. So it's funny because I started at the Fed in international research, and at the time, it was what was called the LDC, lesser developed countries, which we call emerging markets today. And they were talking about the debt situation in Mexico. And they said, oh, crude oil is this. If we could just get Mexico to pump a lot more oil, and given the price of this, they'd get a lot more revenue. And I made the mistake in the meeting of holding my hand up and said, wait a second. If they pump a lot more oil, that's going to add to supply. Isn't that going to force the price down? We're going to need some type of dynamic pricing model. And that's when they moved me out of sort of direct research and down into covering more futures and options and trying to build some models around that. And that's so each step of the way. And then when I went from the Fed to Tudor, and of course, Paul's personality and his tremendous skill, and I learned early on that if I gave Paul the exact low in the exact high in a market, he would still make a lot more money than I would because he's a much better trader. And by the way, usually I'm much better at buying the exact high and selling the exact low than the other way around.
What about you, Jerry? What are your...
Yeah, I mean, I'm really interested in, selfishly, your opinions on me personally, and then CTAs in general, and how you've seen it evolve over the years, and the way the industry has. You've been in it, you've kind of been out of it, you did it differently, but and you've seen a lot of smart people who had a blend, as you said, maybe didn't talk about trend as much as the trend followers, and I think that I'm interested in your opinion on that as well. Are we talking too much about it? Have we been too successful in telling people how easy and simple trend following is? Has that hurt the industry and the AUM? Where do you see CTAs today, or at least a few months ago when it was a lot worse? And how do you see them getting better for the future?
So first of all, I'm going to talk my own book for a second because our business now is accelerating emerging managers. So we're always looking for talent. And in the sense of if there's a new and emerging CTA out there, I'm definitely interested in the data and doing research along those lines. In a diversified portfolio of markets and trading, you need all the different types of strategies. The issue for me with most of the longer term CTAs is the question of, are you maximizing profits or are you running a business? There's two different things where if you're sort of primarily trading your own assets, you can do that. If you're trading a business, then volatility matters and the magnitude of that drawdown matters. And so the biggest issue has always been when there's like a really huge move. So we'll take the 2 days of silver last week. If you and I spent a lot of time doing research on this. If you take all the daily moves of silver in terms of percentage changes, and then you bin them, and you're saying, wait a second, this is a 95% 2-day move in silver, but my stop is way, way far away. That becomes the business question, because you may want to stay in that trade, but if you're an investor with somebody like that, and every investor marks their P&L to the high tick, so that becomes the tricky part. Do you say, well, this is a 95% move? Do I get out? Do I buy and not get out 100%? Because I don't think you should ever do that. But if you realize there's going to be some volatility and the signal is still long, do I utilize technology and then try to buy the pullback? So I start with a lot of these things saying, if I were God, and that would be nice, of course, but if I could go back and I'll look at all my signals and I look at what percentage change of open trade equity do I give back from the high to where I exit. And I think that is where more people should be focusing on their research. So I've always said that entry is easy, exit is hard. So at the time in systematic, and that's why I'm a big fan, the time you initiate the trade, the risk reward is unbelievable. The irony is the faster you make money, the worse it can be because you can't move your stop. So trading, in the way I view it, is more of a second derivative issue, right? The rate of speed rather than a first derivative. And so that's where we focus, and that's where we're looking for a lot of the innovation in terms of research. So it's not, do you like it? Do you not like it? Of course, I like it because, as I said before, the systematic CTA are the only ones that are going to stay in a market when the consensus is it's irrational.
Yeah, I've said that a little bit differently over the years, and I've said, is proper trading, can it be a good business? And I think you're sort of saying, well, it's tough. You look at your research, you look at the numbers, and then you have to say, oh, but my clients won't enjoy that. And so maybe I'll have to tweak it a little bit.
Absolutely. So if you buy a stock and you're an individual, it's down 10%, you buy a little more. If it's down 20%, you buy some more. If it's down 30%, maybe you sell it. In our world, if you're a manager and you're down 10%, people are freaking out. It's just the approach and the mentality, and you have to realize that if you're trying to grow assets and build a business. So the path really matters, and that's frustrating to me because I guarantee you that I've had more 10% drawdowns than I would like to count, and we've always, knock on wood, come back to new high ground.
Yeah, no, I'm sure there's more in that area that we can talk about later. But I wanted to just stay a little bit with your relationship with Paul Tudor Jones. But I don't know if you can. I don't know if you can answer this question. I'm gonna try anyway. It kind of relates to your own role. I think in your bio, I saw that it's also referred to you that you do some coaching, trading coaching. So maybe there's a little bit of there we can use. But I think I first came across this particular point was when I bought Tony Robbins' book called Money Master the Game. And in the book, of course, he shares lessons with, from conversations with many of the most successful investors. I'm sure Paul Tudor Jones is one of them. But since I became aware of the book, often when I hear Tony Robbins talk about his relationship with Paul, he says that, and I'm quoting him, he says that he has coached him every day for 20 plus years. And since I started coaching him, he's never had a down year. So of course, I would love to hear kind of any insights that you might have on this, but also, if a legend like Paul Tudor Jones needs a coach, what does it tell us about how hard it is to succeed in this business?
Well, I can't really comment, with Paul and Tony. I'm not in the room there, but what I can say, and what I do say to every one of our traders, whether they're discretionary or systematic in terms of doing research. Now, the thing with systematic is it's almost the opposite because you have to totally follow your discipline. Everybody gets so scared and proprietary and signals. And I was always like, look, I could put my signals up in the middle of Times Square because when we're in a drawdown, no one's going to follow them. The issue for an investor, and when you're making money, everybody thinks, wow, this is the greatest thing ever, and they want to follow you. And then when you go into a drawdown, well, you're lucky, the world has changed, the model has changed, everything is different. Now, of course, technology has changed, execution's changed, trading costs have changed. And I do think that when we started, and Jerry started, right, the cost of data was high, the cost of execution was high, the cost of trading was high. So it made sense in a lot of ways to have a longer time frame. Now, when you take the other extreme, whether you're thinking about Renaissance or Citadel or Two Sigma, all those costs have gone down dramatically. So they're on the other extreme and they're trading extraordinarily frequently. And I think that the balance is somewhere in the middle. I think markets spend a lot of time doing nothing and then they reprice. So going back to your notion of coaching, I don't care how great you are. And Paul's the greatest. But I tell when I sit down with our guys, I'm like, every time there's a film session, Tom Brady has a coach in there with him looking at the film. You're analyzing the game. You're doing research. You're trying to get better. It's not like the coach. I'm not saying I'm better. The coach is saying he's better than Tom Brady. What he's saying is you're bringing experience and perspective. And the better you know yourself and the more you're willing to open up and discuss that, whether that's your systematic research that you're doing as a systems developer or whether that's analyzing your discretionary trades, the better you're going to be. A good coach puts somebody in a position to succeed. I can tell you for sure, when I was working with Paul, we never had in a situation where I told you so. If I thought something was going to happen and it didn't happen and he didn't do it, he wouldn't go, oh, Pete, you're an idiot. And I certainly, if I thought something was going to happen and he didn't agree and it did happen, I would never go knock on the door and say, I told you so. That is not the relationship between partners, and that is not the relationship between a participant and a coach.
Now, of course, I can certainly understand that as a discretionary trader, it makes a lot of sense with coaching, et cetera. How? But but if we focus on, say, systematic traders, do you think we all need coaches? I mean, we kind of, the three of us, when we do our weekly podcast, we kind of say that this is kind of our way of mentally help each other, through the tough times. But I mean, as systematic traders, of course, we also, I guess it's also nice to be confirmed during the tough times, et cetera. But so do you think that actually both, whether you're discretionary or systematic, that coaching is perhaps even essential for true success? Or
I think it's essential on the systematic way in a couple of processes. One, when you have a bad drawdown, it's really nice to be able to have someone to talk to when you go sit on their couch in their office or you're talking to them and you go, why the hell am I in this business? Because it stinks. And you need somebody to keep you from losing your discipline, because there's always a tendency for the system creator during a drawdown to try to go tinker with it and change something new because you can look at it. So I call it the notion of creeping intellectual cheating. We've all been in the markets for decades. We know what's happened. So it's a real tendency to say, I can optimize, even though I'm not trying to optimize what's happened by using my prior historical information. So you need somebody to really bounce ideas off of to make sure you're not doing that creeping intellectual cheating. And then secondly, one of the issues is the selection of markets. You have your in sample, you have your out of sample, or you have your walkthrough. And as I like to say to a lot of CTAs, you're not trading cocoa? Why? Well, it doesn't work. Well, it didn't work historically, so am I cheating? Am I eliminating that market? Am I, again, creeping intellectually cheating? Am I optimizing in some way where I shouldn't be? Do I have too many of the same markets on there? If I'm trading bunds, bobble, gilts, bonds, 10 years, JGBs, etc., Canadian bonds, Australian bonds? Do I have a diversified, or do I have the same bet on 10 different ways? And how do I treat that? That's where research comes into play. If I want to have all them on, perhaps my initial risk per trade should be much smaller. Because the issue with systems, and again, the other research that you want to do is, do you lever up your new signals? So this is the business question. It's month end. I have to readjust my unit size. I just had a great month in August. I've got all this open trade equity. Do I change my unit sizes based on my open trade equity? So now I know that the probability of any given trade, and this is why the discipline is so important, is always a negative. If I don't do a trade, I'm likely to save money. It's the risk reward of when you do the trades that when you make money, it's 3, 4, 5 times to 1. So now if I use increasing my unit sizes based on open trade equity, and I know we're getting into the weeds here, and then I have a new signal, and then that signal doesn't work, and I have a give back based on my open trade equity, that's how big drawdowns start. So these are not tinkering with your systems. These are approaches and methodologies that need to be consistent over time. And it's really helpful to have people you can bounce ideas off of.
Yeah, I've made all those mistakes. So I think my background sort of lent itself and was encouraged to be an individual trader. And so you may hang out or you may chat a little bit, but not too much. And a lot of the very successful firms in trend following, in systematic trading even, they went out in 2s and 3s, and they were partners. And all of my friends, we just went out on our own. And I think it's this sort of camaraderie and coaching and holding each other accountable. Let's write down the 10 things we believe in and make sure we're not ever violating those. And when you start your own firm and you start making money, and get successful, you will see a lot of yes men and women. Yes, Jerry. Yes, whatever you say. And I think in hindsight, I think having a couple of trusted partners, who there was maybe 3 people who were the people in charge, that's harder to deviate from what you believe, but you can definitely get away from it if no one is calling you out or feels they have the power to do that.
Well, unlike you, I'm not so nice, so I don't have any friends, so that's not really my issue. But I do think that one of the issues and the mistakes that I've made is you're growing a business and somebody says, hey, if you just do this, this, and this, we're going to give you a big allocation. So you spend all your time sort of doing this on the hope of getting this allocation. And intellectually, you're like, I don't know if it's really the right thing. I'm sort of, tinkering with my model. I'm trying to do this. I'm trying to have fewer markets. I'm trying to reduce the volatility. And you do all this stuff. You spend all the time. And then you go back to the investor and they go, you know what? Things have changed. The markets are going up. I don't need you. And then you do these things and you come back with your track record after a drawdown. And then they go, well, the market went down. I don't have any money to give you. And that's kind of the CTA story and the frustration that we have because we're really good at making money when things get out of whack, right? So we're there during instability. So if you said to me and you go, okay, we're at historically concentrated sort of low volatility periods, that's not the ideal time to be a CTA. But is this a new permanent state or is it a transient state? Now, my own view, of course, is that it's a transient state because I believe in cycles. And people are like, what do you mean it's permanent? I go, hey, you know what? My dad just turned, this is true, 92 last week. But I tell my dad, I go, listen, I'm not buying a 115 call. You have to prepare. And every day, wherever we are in this cycle, all I know it's one day closer to the end, and it's one day where closer to where systematic CTAs are likely to outperform for more than just a short period of time.
Great, Peter. I love that. I just want to speak a little bit about consistency because that's what we've just touched on. I mean, I think everyone likes to make money every minute, every day, every year. Our clients like that. We know it's unrealistic, right? So to me, the consistency is to press the button and continue with the system every minute, every day, every month, every year, and not tinker with it too much, right? But then inevitably you have those periods where the system doesn't work so well. You're in drawdown, you're at -20, you're at -30. And, I've been there. I've never been coached. I know how difficult it is to stick with a thing when you're at -30. I'm not sure if I could do it if I'm at -50 or -55. I hope I'll never get there, but it's probably terribly hard. But, how do you find the right compromise and the right middle way between sticking to the thing that you've developed and moving it forward through evolution, through new research? And, you've mentioned the exits. We'd all love to have great exits that, don't whipsaw us and, keep more of the open trade equity, but we know it comes at a cost. So how do you find the balance between sticking to a thing as consistently as you can, because that's important, and changing it because that's a necessity also?
So I think it's a question is, as Jerry said, are you trading your own money to maximize it? You can have more volatility. Or are you trying to run a business, and in which case you have to sort of maximize what your investors are interested in, and knowing a priori that they are not going to be able to handle that volatility, then you have to adjust your model for that. Now, whether that means trading smaller positions so that both sides are going to be if everything else stays the same, both sides are going to be curtailed, but the volatility is going to be less. Or two, whether you try to develop some systematic approach to have profit objectives, to scale out of positions. What you can't do is just randomly feel, because then you're just the worst of both worlds. Right? You're trying to be a systematic person and a discretionary person at the same time, and that is totally horrible.
Right. But I think, my point is more like, let's say I'm running a 20 vol system. I can just trade the same system at 10 vol or 5 vol,
Yes.
right? And have a smoother experience, and my clients may like that better. But we're speaking about consistency, and I want to press that button and keep the system running without changing it too much, because likelihood is that I'm going to change it at the worst point in time, which is when I am in a drawdown, right? But at the same time, we realize that every once in a while, markets adapt, markets change, you make changes to the system. So how do you find that balance? Like, there's a need to change the system and maybe go through an evolutionary phase, which is contradicting to like sticking with the original version.
So when someone walks into my office, whether they just had the worst day of their life and it's a system, or they're a discretionary trader, and I talk to them, I go, I've got good news and bad news for you. And they go, what's that? I go, well, the good news is you're still in business. And they go, so what's the bad news? I go, if you're in business long enough, you're going to have a worse day. Records are made to be broken. So you have to do some, simulations, Monte Carlo research on your model. Just because it's generally speaking a 20 vol, that doesn't mean that you can't have 33% or 40% decline, and you need to know that going in, and that needs to be disclosed to the investors. When I give sort of this trading presentation to people, one of my slides is, never minimize the pain when looking backwards from a positive outcome. So if we just do a little math here, and I don't want to pick on the equity market, but I tend to enjoy doing that. So if you start off with $1,000 and you make 7% a year for 50 years, at the end of that time, you'll have what, 32,000, or make it 100. So you'll have $3,200, and that's a 7% compounded return. If in year 51, you lose 50%, people would totally freak out because you'd have $1,600. But that compounded annual return only declines from about 7% to 5.9. That's the illusion that people have of time and money when looking backwards from a positive outcome. And I can assure you that every single one of us, if we have that kind of drawdown, our investors would be leaving and freaking out, where, of course, in the equity market, it's a buying opportunity of a lifetime.
Does that answer your point, Moritz?
Yeah, fine. Thanks very much.
But I think in general, Moritz, I mean, the point you bring up about, I mean, I see it all the time when you meet with investors, right? I mean, people want you to evolve, but they don't want you to change, right? So that is the balance we're up against. But I think certainly in our case, on our side, I mean, the research projects are typically very long term, so they are not really impacted at all by where you are in the performance cycle at the time. So you either find something that you truly believe in, you test it over time, you do all the things you have to do, and if it's good enough, you might implement it. But I mean, I think if I think back on Dunn's 45 years of history, I mean, the first change didn't come until 2006. It's a hell of a long time without making a lot of changes. And since then, there's only really been about a handful of important changes. And I think that goes to the testament about, the robustness of some of these strategies, really. But I think it is a very interesting topic.
Yes, I'm just sitting here thinking about things I've read recently. One of the things that's always floating around the CTA industry, which I don't really think is always accurate, which is that more education. We just need to give them more education. When I was 25, I read about trend following for the first time in my accounting job office, and I was sold right there. It only got more deep and more dedicated and passionate about it. So education, no, I don't. I'm sure that it's the easiest thing in the world to understand. And then recently, I've been reading that clients don't like to think that, why should I pay you to just run this system? You're not really doing much work. I don't really like systems. It feels like you're tied to this and you can't do anything because the system has control over you. And now I picked up from another idea from Peter, listening to what everyone's saying, and that is, I don't like the results of a systematic trader, because the results, the system, the back test is saying, hold on to those profits. Don't get out of that silver. Silver's fine. And so bottom line is you're sort of giving me the impression that, which makes perfect sense, is that it's the characteristics of the equity curve and the daily performance. I really dislike that. I marked my P&L to the high tick last month or this month, and now you're down a little bit. So, but to some degree, you got to admit that they probably don't say that about Warren Buffett, or maybe they never said it, or they certainly don't have that attitude about the stock market in general.
So it's because its perception becomes reality, because they look backwards and they've seen that they've always come back to new high grounds because they understand it. And the hardest part for a CTA, and I remember this because I was at a conference in Europe with one of the largest at the time trend following CTAs, and he goes, I really have a hard time raising money. I'm like, why is that? Your performance is great. He says, because I go into a meeting and they ask, so what do you have on? And I go, well, I'm long the euro. And he says, well, why are you long the euro? He goes, because it's going up. And then they say, well, when are you going to get out of the euro? And he goes, when it stops going up. And he goes, that's not a particularly exciting meeting. The people that are on the other side of the table, they want to be able to think that they're really intelligent, that they agree with you. Well, there's the interest rate differential. The economies are slowing in the U.S. relative to Europe, so I want to be long the euro, and I have this, and this. And they go, okay, that makes sense. And, of course, that's what happens in individual equities when they go. And so when that happens and it goes down, they still believe their own story, or they don't want to admit that they were incorrect. But what Jerry just said, which is funny, is, well, we don't like systems, but what's the hottest thing in the equity space right now? Quantitative strategies, alternative data. As usual, when you think back of since the early 80s, the CTA and futures markets participants have always been far ahead of the curve. We just haven't been as good at accumulating assets. Now, part of that is for regulatory reasons because of the differential between the SEC and the CFTC. And an individual can go online now and trade a, triple levered ETF being on any kind of SEC account, but they can't go and trade S&P futures, which are cheaper and better and have a greater return. So there's a whole host of reasons, but it goes back to individual investors, and I'm a big sports guy. And you think about an international game like the NBA, and the individual investor wants you as the coach or the manager to treat every day like it's game 7 of the finals. Only play 6 guys, only play 7 guys. And if you do that, of course, you're going to not go anywhere over the course of a long season. So one of the famous sayings is, if you listen to the fans, you eventually end up sitting in the stands with them. And that's what I was saying earlier about the fact that you have to follow your own discipline and your approach and your methodology, because oftentimes you listen to them and that's exactly the wrong thing to do.
You kind of got into, and you and Jerry got into something that I wanted to explore maybe a little bit as well. So for me, at least, sort of behavioral finance is a relatively new term in our industry, at least when it comes to the acceptance of it, because of course some of the literature actually goes back quite a long ways. And I think it's a fascinating way, really, to illustrate why being a quant and following rules is a really good way to overcome the weaknesses we have as human beings when it comes to investing. So I was actually gonna ask you, Peter. I mean, if you were going to do our jobs as trend followers, meaning, and I know you kind of touched a little bit upon it, but I want to go a little bit deeper. I mean, how do you think in the world we live in today, with the investors' focus as it is today, I mean, how would you pitch kind of this rules-based trend following approach to make it sound, more appetizing than what we perhaps see in the real world today?
Well, that is a difficult question, but I view it, and when I speak to people, the markets are always trying to make you lose your discipline. A systematic approach to the marketplace, if you actually follow it, which is the hard part, forces you to keep your discipline. And the great thing about the intersection of system development and technology is, and I'm as guilty as this of anybody, I would never like the systematic developer to actually execute the trades, because they could talk themselves out of any given trade. But when you have the signals, whether that's in the earlier days, you had a trading desk and you had people executing those signals, and their work depended on them actually following that, even if it was really, really difficult. Or today, when you put them in an OMS and it goes out there into the marketplace and you make those trades, the key is following your discipline. That's super tough. The other thing is, like everything else, and in markets more so than anything, after the fact, it's obvious. Everything is obvious. Oh, it was obvious in 07 and 08 that the housing, if it was so obvious, we wouldn't have these kinds of volatility episodes. Everybody's going to say, oh, whenever happens next, I can assure you it's going to be obvious, but it's not. But the discipline of a systematic approach is essential. Most people aren't good at either. They're not good discretionary traders because they can't keep their discipline. And oh, I'm in a market, and this is the biggest difference. As Jerry was saying very much earlier, oh, the market's in, I got a little profit, I don't want to give it all back, I'm going to get out. So it's that trade-off between you want the market to tell you what to do. You yourself don't want to tell yourself what to do, but it's easier to listen to yourself than it is to listen to the market.
No, absolutely, absolutely. I mean, I still find it incredible when you hear some of the experts talk about behavioral finance. To me, it really sounds logical that the way to help yourself overcome that is to follow rules, that so few people have embraced that. And even on the kind of institutional investor side, just from pure diversification of investment process, you would think that what we do adds a lot of value. Yet there is a lot of resistance in many shops still to embrace that, and we go back to the same thing I'm sure you heard back in the 80s. I mean, it's the black box syndrome. We don't know what's going on, yet they think that they know exactly what goes on inside the equities they buy, or the various long short equity funds they seem to love so much. So it's an ongoing challenge.
It's interesting because every discretionary trader I know says if I just had a system to help me pick and choose my signals, I would do better. And every systematic trader I know says, if I just had the discretion to pick and choose my signals, I would do better. And you end up with the worst of both worlds. If you're discretionary, you stick with that and your skill set. If you're systematic, you stick with that, because it's that one trade that you don't take. So for all of you who are long bunds, when they went from 20 basis points through zero, and every person that you spoke to said you are totally out of your mind, that's not possible, and then they took out the 16 low of 25 or 30 basis points, they said the same thing. You followed your discipline. That's the key to success over time.
Yeah, but let me spend some time thinking about some of the things I'm confused about. One is, because earlier you said something that maybe seems different than what you just said, which is at Tudor you had both going on. So I guess what you said was that maybe that Paul wasn't the one doing both. He did his discretion, and you had a discretion. You had a systematic, a separate part of the company that did some systematic stuff. And so what you're basically saying is don't mix the two, or maybe you're saying like if you're going to do something that looks discretionary and not typical trend following, make rules for that as well. So if you're going to have profit objectives or get out of some of the silver after just a 95% move, which is not going to look good on the back test, okay, that's kind of discretionary, but don't make it discretionary. Make it a rule-based thing that makes it look like you're doing discretionary plus system or traditional long-term systems that are going to look good on the back test. That getting out of silver at 95% is not going to look good.
So it's a combination of all threes. Yes, the mismatch is just sort of mentally confusing, and you're going to feel like you're a cosine in a sine world, and you're going to be totally out of sync. What I was referring to in the case of silver is your part of when you're building the business is what's the variable you're maximizing. So is it the profitability, which is you're doing by letting it run, or are you looking to maximize or minimize some type of drawdown, in which case I'm going to build in certain profit objectives to try to have a smoother equity curve. So I can do that by saying in my risk reward, if I'm going to do this, I'm going to get out of silver at X% increase from where I got in, and then I have to follow that discipline. Now in the long run, that may not maximize my money, but if I'm running a business and I therefore have a smoother curve and I get more assets under management, et cetera, that's a different variable I'm trying to maximize. If I'm a discretionary trader and I know from history, then I'm just like, hey, this is a great day, And my goal as a discretionary trader is to end the day with a little more money than I started with. Is completely different approach than it is as a systematic trader. But in the systems, it's a question of what is the variable you're trying to maximize.
Yeah, but I'm laughing because, I mean, I may be in the minority and I may obviously be wrong, but to me, I have to say, the the difference between those two is that the systematic guy actually has evidence that what he does works in the long term. So, but a funny thing back in 2009, UVA investing conference in Charlottesville. I went to it, and Brian and I went to it, and Paul Jones, Lee Ainsley, John Griffin, and Julian Robertson were there. And Paul was trying to get the two fundamental managers, Ainsley and Griffin, to agree, what do you do with this chart? It's a chart with, it's going in a big uptrend, or it made a new breakout, and they were like dumbfounded. Well, I don't know. I mean, what do you mean, the chart? And he was like, you got to buy that, you got to always be on the right side of the 200-day moving average. And, those guys were there with their mentor, Julian Robertson, and they were like, no, I don't know what you're talking about, basically, and I'm not sure about that trend stuff. And Julian piped up and went, no. I have a new respect and a like for trend following. I think it's something, the trend in general, you have to respect it and you have to sort of pay attention to it. And I was like, Brian, we need to get up and leave right now. It's not going to get any better than this. So I think over the years, I've often just kind of wondered, and I asked you this question before, do these famous macro guys, do they kind of pay attention to trend? Is the reason that they have so much money in their management, besides good performance, is because they don't really talk about trend as much as a story, owning these stocks. They owned a lot of stocks, more than the CTAs, in the past periods where stocks have been the best performer. Just trying to uncover, could I have done the same thing if I would have just had a better story and maybe traded more stocks? And like you say, maybe not been a pure trend follower to the degree that I've always been, and had profit objectives and managing my equity curve more.
So I think the story is there, as I was saying earlier. People like the story, number one. But realistically, what Paul was saying is that you succeed, and we always had this saying, it's discipline before vision. So you can gossip about markets and you could think it's a good buy or you could think it's a good sale, but you need that discipline. So whether Paul's saying you have to be on the right side of the 200-day moving average means I'm going to have that discipline, because it's the exact opposite of human nature. The funny thing is about the indices today and forcing you to stay long these stocks is that they're cap weighted indices. So the higher it goes up, the bigger the weight. These are actually the most trend following characteristics of anything that's out there in the marketplace now. And if it goes down a lot, it has a smaller weight. So it's actually, if you're an investor, you may not be aware of this. You're sort of buying high, and you have to get longer if you want to maintain that index because its weight goes up, and vice versa when it goes down. That's almost forcing you to have some sort of discipline. So I think the story is difficult. Part of it is the language, and it's not just education, because I've been working on this education. I sit on the educational, the Institute for Financial Markets, which is the educational not-for-profit of the Futures Industry Association. And I've been doing that for 30 years. And it's the same thing all the time, more education. The difficulty is that the story is always the outlier. So they like that outlier guy that bought that stock that really went down and then went up. And when you're watching the financial news, they talk about the stocks that have gone up. They don't then talk about Tilray that's down 90%. They only talked about it on the way up. And I promise you this, that the people that bought it on the way up for a trade, they'll hold on to it because now they're investors. And our approach is a rigorous disciplined approach, whether that's systematic or discretionary. And you need a governor to tell you you're wrong when you're trading discretionary, and the governor that you use when you're in systematic is your history, your stops, and your ability to get out. And the key is surviving to live and trade for another day.
So, Peter, how do you make sure a discretionary approach is rigorous? Because, like, as Jerry said, there's no evidence there. There's nothing that you can backtest. You're missing the statistical sample. So how do you make sure that there is consistency in a discretionary approach?
Well, it's time and track record. We don't buy the story in our business. You need to have a real-time track record. I know that going forward, that returns are not predictable, which is funny, right? Because that's the first line of every disclosure document. Past performance is not indicative of future results. Yet that's the first thing that everybody looks at. Well, I'm only going to be in the equity markets because they've gone up. Well, I can't invest in a systematic trader because you've had, a drawdown, where if you were a stock in a stock curve, they would be buying the drawdown. So you need data. The one thing that is more predictable is your volatility. If you look at daily returns, whether it's a systematic trader or a discretionary trader, that is a reflection of the personality of the creator of the system, or the discretionary trader. So that's something that we look at a lot. But I'm a big, New York sports fan. And the question is, why are the Knicks always bad? And why are the Spurs always good? It's not that the Knicks have different access to tools or players, or that the Spurs get somebody at birth and put them in the desert and spring them on the NBA at 20. We all have access to the same tools. It's how do we do it? What's the approach? What's the discipline? Can we develop? Can we nurture that type of strategy? Now, you're not going to go out and have a brand new system that you like and go, great, I'm going to take 100% of my equity and put it in this brand new system, because that there's a probability that when you have a new system, I always say new systems equals new errors. Or, when you have all these different rules, and you don't want to have too many rules, because I always like to say rule number 13 is that there's just exceptions to the prior 12 rules. Then that's not a system.
That was a bit of a downer for me that you said the Knicks are bad. I just bought tickets actually to watch them in October, but there we are.
Well, it's the season hasn't started, so there's always hope.
Exactly. I know there's always hope. Now, just staying with this, I mean, I'm sure most of these legends in that the press love to write about. And I'm just still wondering a little bit, and I think this is what Jerry was also trying to get at, but I'm not sure whether we kind of got there. And that is, do you think that these people are deep down actually are systematic? And they just don't talk about it in that way. They just talk about it in a completely different way. They use different narrative than we do, but deep down, they because I can't imagine that they're kind of seat of the pants traders.
Every successful discretionary trader is rigorous and disciplined and has a consistent methodology. If that's how you define a system, then they are human systems. And as I said earlier, the market is always trying to make you lose your discipline. I know no great discretionary trader that goes, I'm going to average down. I'm going to average down. The sign behind Paul's desk, losers average losers. Averaging down works great until the one time when it doesn't work, and then you're out of business. You're not a legend if you're out of business, and you're not a successful systematic trader if you're out of business. Discipline before vision. The system embeds that. A successful discretionary trader has that discipline. So they're not seat of the pants at all.
Speaking about business, I mean, I would love to hear a little bit more about what you do now at Quad Group. I mean, it's an interesting business. I guess there's been maybe a few similar ones that's sort of come up in the last few years. I think Jack Swagger is doing something about finding talent. And of course, and I don't know exactly whether that's included in your business, but of course, the really big funds like the Millenniums of the world, where they have a lot of these sort of smaller trading teams. I don't know if that's something you do as well, but feel free to share a little bit more about that.
So, thank you. We're not really trying to compete with the Millenniums and the other ones, because they're really looking for very, very big traders. And I think that that's hard because there's a big demand curve for them, and the supply curve of really big traders is not that large, sort of by definition. We're looking for smaller traders that trade, long short equity, futures, and options that have capacity constrained alpha generating strategy. Now, in my mind, what the marketplace is looking for sort of people that have an average holding period of 3 months or less. So we sort of call it an earnings cycle. So we look, you need to have a real-time track record. You can't have taken, a 10-year break and go, wow, I'm ready to get back into the business. Go look at my track record from back then. You have to be trading. If you have a team, we have options for that. We sort of have 3 different things. If you have a strategy, but not a business, so you're trading some of your own money, it's a system, discretionary, you have a track record, but you don't have managing other outside money, you don't have an office space, you're not registered, you need to be in our space. If you have working capital, if you're out there and you're managing other money, then we can do an external managed account. And if you want to be in our space and you want to have an external fund, you want to start, that's your dream, then we can work with that as well. We can provide middle office, back office, and do some sort of revenue share. But this is a very difficult business. It really is a lot like sports. And every 10-year-old boy I know thinks they're going to be playing in the NBA. And I say to everybody, you got to figure it out by the time you're 13 or 14. You got to get on with your life. Don't tell me you bought Google and you're a hedge fund manager. So it's one of these things which is much more difficult said, or much easier said than done, excuse me. And so we have to spend a lot of time analyzing that. And I do spend a bunch of time looking at bad numbers.
How many people do you think you see, and of those, how many do you think, or how many of those do you pick? I mean, how difficult is it to find true talent?
It's extraordinarily difficult to find true talent. It's probably in the neighborhood of 4 to 5%. But my attitude is you need to look at everybody. We're not super big. And I go to every person you named, whether it's my old firm or for other firms you named. And I said, you've got the best names in the industry. Everybody sends you their resume. But if they can only manage 25 million, instead of you saying no, send them down to me. They may not be there, but I'm always looking for that talent. You just don't know where it's going to come from and what the methodology is. Now, do we need another person that day trades S&Ps? Probably not. So that's going to be a much higher hurdle. So it depends on the strategy and on the approach. And we saw all sorts of sort of discretionary, VIX type traders. And after the XIV went under, the whole market dynamic changed. So do I need to see another guy that, sells volatility and buy S&P as a hedge? Again, probably not. So it's pretty difficult. And we know the nature of asset management has changed as well. No one's going to pay us 2% to be long the FANG stocks. And by the way, if you know people, I'll take all the money that you want to allocate and pay me 2%, and I'll buy all those stocks and hold them for you. But I kind of think that business is gone.
What do you see for the hedge fund and CTA business in the future? How do you see it sort of evolving and getting better? And yeah, what do you think about that?
I'm very optimistic because, as I said earlier, I think that we're at the end of a cycle. You're seeing that around the world. If you, for example, look at a chart of the Euro Stock Bank Index, you'll realize that stock index is down 90% from its high. The United States is the heart of markets, and what you see is that countries around the world, they've totally underperformed, whether that's the EEM, whether that's individual countries, and that's likely to come towards the U.S., and that's going to be optimistic for our business.
And I've always enjoyed your kind of analysis of the current situation, especially if it's something I haven't heard before. So do you have anything that it's very confusing now as it relates to interest rates and stocks and bubbles and value? What do you see for the U.S., the politics and the economy over the next few years?
So I try to stay away from bubbles because everybody likes to think that something's gone up a bunch. So we'll say bond prices have gone up a bunch, so that's a bubble. Or where we see things are from a macro point of view is I start with the internet is the greatest deflationary machine ever built. And technology is making it possible to produce more at every price, and people don't realize it makes you easier to use it more efficiently. So if you have more supply and less demand, that puts downward price pressure. And unless the demand curve shift out, which is not what we're seeing, we're going to have this continued deflationary pressures. You're seeing that in the commodity markets, and I think that's going to have implications for the equity markets. And I always define at the end here, I'm a Democrat that believes in markets. Markets work. If we go back to our Knicks analog there, you don't need to be a PhD in economics to realize that it's easier to get a Knick ticket than it is to get a Warrior ticket, right? Markets work. So I think that the deflationary pressures are building up, and we have not addressed that from a policy perspective, and that's my biggest concern.
I saw an article this week, or maybe it was last week, from the guy who was featured in The Big Short. I think Michael Burry, I think his name is, about him talking about the big issues that he sees in terms of passive investing and the size it commands today in our world. Is that something you worry about in your work, Peter?
Well, I don't worry about things that I can't control. So I don't worry about that. I look at that as part of what we were talking about, the construction of the indices and the fact that you have to buy more. So if a large cap individual stock has issues, which you started to see in the fourth quarter of last year, that is going to magnify the speed at which these things go down if there's a correction. So what we saw in Amazon, what we saw in Google, markets and stocks don't grow to the sky. I also know that math works. So these stocks, whether it's Microsoft, et cetera, cannot compound at the same rate of speed over the next 5 years as they've done over the last 5 years, or they might be the only stocks in the world. So if you believe math works, it doesn't matter whether you're bullish or bearish. It's just that if I said earlier, trading is a second derivative, that second derivative is going to decline or certainly approach zero. And so if they all stay the same, the indices aren't going to go up a bunch. And that provides another opportunity for our business, which is one reason why I'm optimistic.
Just for me to understand that right, is all the trading that happens at Quant Group model driven and systematic, or is there also discretionary traders?
It's
there?
a hybrid. It's
a hybrid.
Each individual or team has their own approach, and we're overlaying, making sure they're swimming within their lanes and following their discipline, and we have risk management on top of that. We're not babysitters. I always like to say this business isn't that hard a priori. If I give you $1 and you can lose 10 cents, if you're down 9.9, you're still in business. If you lose 10.1, I just want to send you a black sweater with a yellow QG on there saying you've reached your threshold. We're going to close the account.
With the systematic trading, just in terms of the instruments, have you ever, seen purely systematic traders trading in, say, options nonlinear instruments, or is most of the things in like futures and stocks and ETFs and stuff like that?
So the short answer is yes. And also I have my own prejudices. I'm not a huge options fan because I think that when you trade options, as I said earlier, records are made to be broken. So you buy options betting the record's going to be broken. You run out of money before it's broken, and then everybody sells options, and then you go bankrupt when it is broken.
So maybe I can just dive in here with something I wasn't quite sure I fully understood. So on one hand, you say discipline before vision, or you have to have the discipline, right? And on the same side, we say, well, we don't really know what the future holds. So if we followed a disciplined approach and say it's a 10 vol strategy, we don't know if the drawdown is going to be 10, 15, 20. It could be, but if we believe in the stats, if we believe in the history, we should be okay. But we don't know exactly where these drawdowns are. So I don't know if you do this, but you refer to this thing about, giving your teams a specific drawdown level. So if you're down 10.1, you're out. We see that a lot with these big shops where they give them very, very tight drawdown levels and they're out. And that I don't quite understand, because it's almost like we're not accepting the fact that we can't, if we're following our systems, we're doing all the right things, we just don't know exactly where the drawdown is going to be, but it doesn't mean the strategy is broken. So how do these two things marry, giving people such a specific drawdown level, yet wanting them to follow their system and their rules?
Because we don't pay management fees. We want you to trade smaller and be there for a while. When I give an allocation to somebody, I can be like, you can be an idiot and lose it all in a day, or you can be like most people and lose it more slowly over time. It's a really hard business. So we have to have that internal systematic discipline. So I tell everybody, look, it's make it, take it. We're not saying a 10% drawdown from peak. We're saying we give you this capital and this is where you are. If you start making money and you want to be more aggressive, that goes back to the open trade equity question. We're okay with that. Demonstrate that you can actually make a layup before you go out to the 3-point line.
Yeah, a lot of what Peter has said, it's sometimes said differently in terms of money management and risk control, and these ideas of incorporating open trade profit into your trade level. He mentioned that kind of earlier. Then the unit sizes, how big are you trading? What leverage are you trading? Are you doing essentially the same trade? Do you have 14 bonds on? I think for some people that's low right now. They have way more than 14 bonds on. And so I think in earlier, you were saying that all the successful people have similar characteristics. And to me, a lot of what you said was about money management and risk control. And, okay, you're maybe sort of average or above average as it relates to entries, exits, discretion or systematic, but you got to get that money management cut back when you lose. Back in the day, we traded very large, and after 84-ish, I think, we were making about 200% a year, shorter term trend following with very strict position reducing and trade size reducing rules that almost overwhelm the system itself. You kind of can kind of dominate with some of the money management rules, and the world has changed a lot since then. But it was definitely a successful and a great way of doing things. But no doubt over the years, I get confused as to where does the trend following begin and the risk control and capital preservation start. It's all, to me, all one big thing for all of us CTAs who are trading so many different markets and taking small losses and going long and short. I personally don't vol target, but that's the European CTA contribution to finance, how important it is and necessary and great it is to sort of always try to get to a similar vol target every day.
Getting a vol target every day is virtually impossible, because, markets ranges expand or not. But what's possible is to sort of say, what's my maximum vol target over time? And that's what we try to, encourage from the beginning. Don't start off in the ditch.
I think another thing we've all been trying to get you to tell us for the hour is when you and it's, you definitely don't have to, just make sure we're all being clear. But is this idea, and I'll put it in terms of the quad group, you get this manager and you like him, and he's kind of using some price and some trend, and he's like, he's maybe not a turtle style trend follower, but he's using a lot of good techniques that maybe trend followers use. In order to help him grow his business or grow his business with you and get clients to invest in your trader, what do you do? How do you help them? Not the psychological, the counseling or the coaching, but you say, no, you're not going to put that in writing for these clients. You're being too transparent. We're going to have to mystify it a little bit. And plus, I have friends who trade in New York for hedge funds and pretend that they're not trend following. So they're scouring some story about why they're short soybeans.
Yeah, so everybody likes to have a story that's part of it. When we're working with somebody and they want to raise additional assets, so first of all, we want to grow them. So one thing about you, which is unique with us, is we give them an initial allocation and we predefine levels at which they're going to grow. It's one nice thing in which to partner with us. So it's not like, hey, here's an account, one and done. Maybe we'll raise, maybe we won't. We have a process and a methodology to do that. They like that. In terms of growing and building the business, yes, the deck matters, the presentation matters. Of course, performance is always most important, but it's the approach. And for us, as I said, somebody getting lucky in one market doesn't make them a successful trader. So what are they doing? What's their diversification? And then how do they perform over different cycles? And of course, we're looking at cross correlations, not only to the market in general, the equity, but also among the different people we have allocations to.
When you meet all of these managers, Peter, and with all your experience, I mean, what are some of the most important questions that you ask them?
Wow.
For you to get that, that kind of, yes, this really has something to it.
I want to see, particularly on the discretionary side, if they're following their discipline. And we've had literally examples where they come in and say, well, we're doing this. We're kind of swing traders. We're looking at, 4-day lows where our stop and so forth and so on. And then we look at their track record and we simulate it and it looks good. And then we have an allocation to them and they're not doing at all what they said. I'll pull the money almost immediately. Right? Getting lucky, and if they make, is not a long run solution. So we ask all sorts of questions depending on where it is, but we're more data dependent than anything. And I just sort of want to end with this point. With the nature of technology, is people think, well, it doesn't really matter. You can do business with anybody because it's technology, whether that's execution or allocation. And the irony is, if you can do business with anybody, you're only going to do business with people you like. And I want to like the people that we allocate to. I want them to be humble. I want them to be hungry. The days of some person sitting in the corner who, sort of annoys everybody but makes money, in our business, that's gone.
Yeah, no, very good point. Let me just, as we bring this to a close, I'm sure there might be one or two questions more, but let me just quickly run through performance so far this month. And then Moritz and Jerry, if you want to think about another last question before we wrap up. But as of Thursday evening, I think Friday was an okay day for most CTAs, but as of Thursday at least, the B-Top 50 index was up 0.19% for the month, up 12.53 for the week. For the month. Sucked for the year. I'm all over the place here. Let's do that again. The BTOP 50 index is up 0.19 for the month and up 12.53 for the year. SocGen CT index down 1.85 for the month, up 9.82 for the year. The SocGen Trend Index is down 2% for the month and up 17.5 for the year. And the Short-Term Traders Index down 73 basis points, but still up 2.3 for the year. And finally, the Bridge Alternatives Index down 1.48 for the month and up 15.101 for the year. So, Moritz, Jerry, any final thoughts, questions for Peter?
No, just thanks for being here. It's been a blast. I look forward to seeing you soon in person.
Same here. And, when you guys are in New York the next few weeks, let me know. And Jerry, of course, will continue to intellectually have some fun.
Thanks, Peter.
And by the way, opening season, kickoff, let's go Jets.
Absolutely. Peter, thank you so much for spending part of your Sunday with us. We really appreciate this. This has been a real treat for us and for our listeners. That's it for this first year or year one anniversary edition. From Jerry, Moritz, and me, thanks so much for spending part of your day with us. We're grateful for your support, and we can't wait to be back with you on next week's edition.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some